it live on YouTube so that everyone can watch the recording later also. So now we're live. So good afternoon, dear friends. Today we have a financial webinar on role of equities in the wealth creation. I request Dr. Niti Agarwal, Secretary, IIP Delhi branch, to start the proceedings.
So good evening, everyone. I welcome you all on behalf of Equities Jain. And today's webinar is on a different aspect of health, is a financial health, and by financial super specialist for doctors from doctors, and moderator being Dr. Ajay Kumar Gupta, our spokesperson of North Zone Central IT, and contestant Delhi IT President. So stage is yours, Dr. Ajay.
Thank you, Dr. Niti. We have esteemed faculty today, Dr. Vipul Jain and Dr. Manish Gupta, and esteemed chairpersons also. And we have Dr. Ajay Kumar, who is organizing the national workshop at the Pedicon in Hyderabad on finance. We welcome him. And we have Mr. Shiv Subudhi, who is MTech and was working with TCS for a long time. Now he has become a financial analyzer and analyst. So we welcome him also. For the first session, I request Dr. Rajiv Khandelwal sir, who is a senior pediatrician from South Delhi, and he had been an entrepreneur. He was running a hospital, Pradhan Hospital, and is now achieved financial freedom. And I request him to please introduce Dr. Manish Gupta. Dr. Manish, please share your presentation. You have the first slide as the CV.
Thank you, Dr. Ajay, to allow me to introduce Dr. Manish Gupta. Everyone knows him. He is a person who is a senior pediatrician and neonatologist at Jaipur Golden Hospital and has been the General Secretary, Treasurer, and President IEP North Delhi. He has been the Organizing Secretary of NCNI GH 215 and IEP trainer. He has been a table tennis player, and he has done his medical education from Gujarat and probably from where he has captured.
Sir, 3 years to best employee.
Over to Dr. Manish.
ఎందుకు చేశారు సార్ పని తక్కువ చేశారు.
Dr. Manish, it's you.
Is it visible?
Yes.
Yes, Dr. Manish. I request everyone to please keep your mics on mute. Yes, Dr. Manish, please go ahead.
Okay. Thank you, Dr. Rajiv. And I must congratulate Dr. Ajay for planning this very important webinar to learn the investing basics. So today we have two sessions. First, I have been given responsibility to define and give you the basics of role of equity in wealth creation. So first we have to understand what is equity. So can anyone tell me what is actually equity? What do you define by equity? You can write in chat box or you can unmute and say, what is equity? Okay. So basically equity is, just now we were discussing, owning a part or a full part of the business, any business, be it your own clinic, be it a business, be it a hospital. So when you are buying a stock, you are buying basically partnership in that company. So that is equity. Now there are different routes to equity. You can do direct stocks, you can do index fund, you can do mutual fund, but everything which is ultimately invested in a company, in a business, is equity. So you are becoming a partner and a part of that business and you are owning it. And when you own a business, you can understand that is where all the risk of loss and profit is there. But most important decision in your equity life is the investment. So the two important points are entries and exits. And that is what we are going to discuss today. First, how the equity is important, how it will compound your returns, and the second part will discuss where to enter and how to exit. So basically, we all know as in our school days and now what is the importance of compound interest. So if you have earned 20 rupees on 100 rupees in a year or 2 year, ultimately compound interest next time you are earning on 120 rupees, not on 100 rupees. So that is the beauty of equity investing, that whatever dividend returns you come after 3-4 years, that is on not the invested money, that is on the appreciated money. So there is a rule of 72. I hope everyone knows the rule of 72. The rule of 72 says 72 divided by rate of interest. Now, if your saving bank is giving your 3% rate of interest or maybe 4%, if the 3% rate of interest is there, if you divide 72 by 3, you will take 24 months to double that money. And if you compare it with average return, if you say minimum to minimum return, which comes around say 10% or 12%, and if we are in such last 3 years, you have even done an return of 18%. So if you divide 72 by 18, it becomes 4. So in 4 years with equity investing, you are getting double of your initial amount, and in your saving interest, say 4%, you will get it at suppose 18 years. See how much early you can appreciate, and no bank with fixed deposit debt instrument that is going to give you 18% return. That much return can only come through your equity. So annual returns of asset classes. What are the different asset classes? First and very simple asset class is cash. You have generated your income and you are keeping it in your cash. You are not having cash at your bank, in your savings bank or current account, or you are having cash at hand. But that is a big loss if you are not investing it for 5-10 years, because ultimately inflation will decrease the value. What is 100 rupees? Maybe after 10 years, it is only 66 rupees or 46 rupees, because inflation adjusted money loses value. Then the other assets are your gold, bank fixed deposit, properties. So as you can clearly see in this horizon of 5-year, 10-year, 15-year, 20-year, equity beats the other three asset class of gold, banks, deposits, and properties. Property has a huge problem of liquidity. You cannot part sell property. And plus there is a risk of possession and lot of issue. And there's a big ticket size. You cannot invest 1 lakh rupees or 10 lakh rupees in properties. In equities, it is as per your ticket size, how big as in CRs or as low as in 10,000. Then comes the question of gold and all this. So the best return comes from equity. Now, can you understand why this more return is coming from equity actually? See, whatever companies are earning, they are using only 20 to 40% of their money. Most of the companies are leveraged. So whatever money we are keeping in bank, we are keeping at 4% or 0% in current account. The same amount that is being given to the companies at say 8 to 12%, and the same business which is taking this money, to that business remaining viable, has to come out with a return of 14 to 18%. Without that return, even that business is not going to be viable. So that is the beauty of getting equity return to the tune of 12 to 14%. Now, what is our goal in equity investment? Our goal is outperformance. And outperformance against whom? Outperformance is against the other asset class. So you are trying to beat inflation. You are trying to beat your savings bank return, which is 4-5%. You are trying to beat your gold or property returns. And then comes the question of stocks versus mutual fund. If you are doing mutual funds, that is also okay. That gives beautiful return, and that is a hassle-free return. But if you are doing stocks, it is very important you beat your mutual fund or index fund returns by at least 30 to 50%, because stock investment is going to take a lot of your money, and it's a high-risk investment. Direct stocks, I mean, owning a company directly, not through mutual fund. that may not even beat mutual fund. Many a times we see it is underperforming the benchmark index fund. So it is just like whether you are doing a job or you are doing a private practice. It's not necessary that private practice may be doing much better than job, but then you always try to do a private practice to excel in a better way. And if you excel well, definitely you can have much better your portfolio return, maybe 18%, maybe 24%, and maybe even more than that if you can catch even 2, 3 good multi-baggers in your portfolios. Now, these are the different types of stocks we own. It may be a blue chip like your Reliance, like your HDFC Bank, like your Asian Paints. All these are blue chips. Or then you have dividend stocks like many government companies or Vedanta stocks like PFC or IOC. They give very good dividends. Then defensive bets. Defensive bets are FMCG bets or your pharma stocks. Then the growth stocks. Nowadays, which are the good growth stocks like semiconductor stocks, renewable power industry stocks, because they are giving 3 times, 5 times, 6 times profits compared to their last year profits. Then the cyclical stocks, like especially the auto stocks are cyclical stocks. If one year there is huge demand of autos, cars, like two-wheelers, then most of the people have bought it. Maybe 3 years down, there will be very less consumption. And once all these autos have grown old and new demand has come up, then the penny stocks like your Yes Bank and this thing. So you have to decide which kind of stocks and what kind of returns are you expecting from your portfolio. Now, just elaborating the basic stocks steps of investing in stock market, you define your investment goals, create a strategy. You want to buy at particular strategy, you want to buy on the fundamental basis or technical basis, you want to buy at certain crossovers, you want to buy certain industry, you want to buy certain cap, like you want to buy a small cap, mid cap, large cap. So you have to diversify your portfolio across all the caps, across major 5, 6 sunshine industries. We'll discuss what are the currently sunshine industries. What is a sunshine industry? A sunshine industry is in that decade, this industry is going to outperform. Like currently, power industry is far better than paint industry, because paint industry, lot of new incoming companies are there. Power industry, however, lot of new companies are coming, but there is so much growth there that they all are adjusting to good returns. Then you choose your stockbroker, research some good stocks, good read books, and attend our good financial webinars to have good investment. So the best tool to make good returns in long terms is SIP. SIP, we all know by now, is systemic investment plan. So giving you a simple example, you can see if you are investing 15,000 every month for 30 years, then at a rate of return of 15% annualized, you are making 10 crores. So at the end of 30 years, this becomes 10.5 crores. And you see, by 30 years, it is 10.5 crores, and the next 5 years, it is becoming 22.3 crores. So a huge difference of 12 crore comes whether you're starting SIP at 20 years for 30 years or at 25 years for 30 years. Because if you start at 20, by 55, it is 35 years. So last good part of maximum return comes in last year. Definitely, as the rule of compound says, if the basic principle is going more, so return would be more. Now, there are few vitals of the stocks, just like we know TPR, temperature, pulse rate, respiratory rate, and blood pressure. We need to know this basics of a stocks if you want to invest in stocks directly. So it is earning per share. Whatever profits the company annually is making, that is divided by number of shares, that is earning per share. So if a company has profit, if a EPS of 10 rupees, and if the company in market is being sold at 100 rupees, then the price earning of that company becomes 10. Now, it is important to understand, we have to know the average PE of an industry. Like if it's a solar renewable wind energy company. Even a PE of 100 is considered normal. In FMCG company, a PE of 50 is considered normal. In banks and pharma, it is varying between 20 to 40. So we have to see average PE. Then the debt is very important. If the company's total assets is 100 crore and the debt is 200 crore, that is 2:1 debt equity. So that is very bad for the company. So the debt equity ratio, we should search for companies less than 1 or less than 0.5. Then return on equity and return on capital. This is how much on their equity, how much on the capital employed they are earning. So higher the ROC, better is the company. If you are using you are using indicators to invest in two companies, everything is same, but ROC of one company is higher, then definitely a good analyst investor would prefer a company with high ROC. And if a ROC is 50, then the P of 50 is also justified. This is a rough guide. If a ROC is 100, then even 80 to 90 is justified. But if the ROC is 10 and PE is 100, that is not good because that company is not growing well. Then the current ratio, then there are few strategies. I'll just going to elaborate in brief 4 strategies how to choose your stock, because this is the most important for an individual investor, how to choose the industry, how to choose the stock. So track asset growth. There are screeners available in various platforms. Like in Screener, you can assess by how much that company assets has grown. Like the Gensol Industries. Gensol Industries has grown, the prices has grown 3000% in last 4 years. And its assets has grown from 10 crores to 600 crores. So that much assets now is there in the company. Then the capex plans, like recently Silchar Technologies, the capacity was 4,500 kVA. They expanded it to 7,500 kVA. So that is 80% increase. So that was greenfield is totally new plant, new factory made, and brownfield is expansion in the same thing. Then the capital work in progress. Suppose the company has 100 crore of assets and they have 200 crore of work in capital progress, which happened with Kitex Garments. 4 months back, it was 220. Today, it is 720. Because whatever assets were there, almost 4 times capital work in progress was there because that much expansion was going on. So that shows in the financial this thing. Then the acquisition, like Zomato bought this Book My Show platform, then Zomato bought Blinkit and all this. So you have to see what extra company is having acquisition, because that is ultimately going to add to the company's annual revenues. Then you have to track promoter in yearly con call notes, investor presentations. All promoters, they tell us how much they are going to grow. Like recently, I came across a company that is your Core Digital. Core Digital had a high of 2,800. Today, it is available at 1,800. The company is in the business of providing pillars and towers to the wind industry and 5G industry, and that has given a guidance of 280%. Company currently is doing around 150 crores. This year, they plan to do 400 crores. Next year, they plan to do 1,000 crores. So see how much growth is coming. Then the sales guidance, new product launch. If the company is launching new hotels, each time we heard this Hotel Lemon Tree has bought a new hotel, Wits have bought a new hotel. Then we heard Medanta is having a new hospital. Then we heard Rainbow is having new hospital. So definitely a new expansion will bring in more revenues. Then comes the question of technicals. We keep on discussing supports and resistance. Once the support is taken support, it is likely that prices will return from there. And when the resistance is broken, it is likely that prices will move from higher. I hope every one of you knows about I think it was Nicholas Cage, who had Darvos box strategy. He made rectangles. Whenever the top of the rectangle was broken, then he bought the share and then he started accumulating. And if the bottom is broken down, he comes out of that share. Then the crossover 50 to 200, super trend, or you can use chart patterns. Like we all know the story of Tata Motors when 600, it crossed a yearly inverted head and shoulder. Straightway it moved to 1200. It stopped at 1200 because it had to be, it had come from 60 to 600 even after crossing this inverted head and shoulder pattern. Now this is head and shoulder pattern. You can see this is the actually bearish one, but this is the bullish one, inverted head and shoulder. When it is broken, it is this much above, it is going to go. Then these are all the moving crossovers we have to see. It is golden crossover when the 50 moving average crosses the 200 moving average. Then you have to track earnings. Every quarter, every annually, you have to track their profits and earnings. Always buy a company which are in profits, not buy the company which are in losses. Because we show what happened with Paytm, what happened with Ola Electric. These companies are not yet registering profits. Then this is an excellent book. You have to read Peter Lynch and William O'Neill. They give you excellent knowledge. And the Scan Slim strategy of Peter Lynch, this William O'Neill is very famous, which is if the current earnings increase every quarter more than 10%, annual earnings increase more than 10%, new product launch, new management, new territories, supply and demand, then see the leadership position of the company and see the institutional ownership, how much FII, DII own that company and the trend in the company. Then comes the question of how to find multi-baggers. Like if the company is having growth in their business, then the EPS growth will come. But EPS growth alone is not sufficient to give you multi-bagger return. Multi-bagger is if you see 10 times return. See, if you bought something at 1,000 rupees, it becomes 10,000 returns. That is 10 times return. So there is a company known as Insolation Energy. Someone told me it was available that time at 500 rupees. Now it is within 2 years, it is 4,000. It is into solar energy. There is a company WebSol. Someone told me at 50 rupees. Today is available at 1,200, 1,300. It made a high of 1,500. So these are all multi-baggers. So what is happening? Not only EPS growth, the P expansion is occurring. So if the currently market is giving you a P of 20, if the growth is there, then startly they giving P of 30, 40, 50. Now even few are putting at 100 of P and plus the margin expansion. Their margin of profits increase. Now, most important thing is often we keep on individually investing in stocks and I keep on listening in our pediatric finance group that ये हिंदुस्तान यूनिलीवर क्यों गिर गया, ये HDFC बैंक क्यों नहीं चल रहा, ये एशियन पेंट क्यों नहीं चल रहा. ये सब एलिफेंट्स है. एलिफेंट्स ना बड़े स्लो चलते हैं और ज्यादा नहीं भागेंगे. तो अगर आपको एलिफेंट्स में पैसा लगाना है तो बेटर है पुट योर मनी इन गुड निफ्टी इंडेक्स फंड और म्यूचुअल फंड. दे विल टेक केयर ऑफ लार्ज कैप्स. यू हैव टू आइडेंटिफाई दैट करंटली कोविड के टाइम के बाद फार्मा चला, बहुत अच्छा चला, अभी भी अच्छा चला, बट फार्मा की एक अपसाइड लिमिटेड है. ठीक है, अभी पिछले 3 महीने से आईटी मूव्ड वेरी वेल, बट आईटी लार्ज कैप ओनली, स्मॉल कैप है, मिड कैप हैज नॉट मूव्ड. नाउ लेट अस सी द व्हाट 6 सेक्टर्स अकॉर्डिंग मी आर नेक्स्ट वेरी गुड सनशाइन सेक्टर्स इन नेक्स्ट 2 to 5 years. Defense and railways, and the good thing is currently they are in correction mode. And correction mode, though 1 year back I didn't used to believe in Elliott wave, what is correction? If a good industry, it should go back. But that's a fact. Back testing shows that correction waves do come, and that is the time you have to accumulate your good stocks. So defense, railways are in very good correction mode. We should accumulate it, and future good order books growth is almost guaranteed in these two sectors. Then comes electric vehicles and clean energy. By 2030, all two-wheelers have to be electric. Lot of penetration of passenger vehicles and commercial vehicles in electric will come. Clean energy. We are going from 300 to 400 to 500 to even 700, 800 of gigawatt requirement for India, and almost 70-80%, 500 gigawatt of renewable energy requirement is there by 2032. And currently we are almost only 100 gigawatt in this. Then comes semiconductors. We all know what is happening in Keynes technology, CG power, lot of this thing. And comes data center like CG power and this Anantraj and all this. So data center, Huge growth is there, and KRN heat exchanger also moved due to this because they provide cooling solution in this. Last but not the least, in stock investing, you need lot of patience. Sometimes you have bought the right stock, it doesn't appreciate. But 2 years, 3 years, if the earnings are good, profits are good, industry is doing good business, prices are not appreciating, that is the time to have patience. But if the business is going bad, if the losses are coming, if the profits are not there, debt is rising, that is time to exit the stock. So the time to exit is if the business is not performing, business is going down, nowhere the world needs that business, or if the company is underperforming, or you have appreciated, you feel the moment is much more. That Titagarh wagon and Cochin shipyard moved from 200 rupees to almost 1800 in last 2 years. That is the time like you would like to cover some profit. You must have patience. It is said if you are doing good stock investing, after 5 years, 4 years, it is 100% that you will appreciate your money in very good way. So that is all from me, Dr. Ajay. Thank you. If you play your stock investing well, you can enjoy life. This is me playing table tennis at Stockholm and Spain and lot of places. So that is how it is. Thank you.
Thank you, Dr. Manish, for a wonderful talk.
Wonderful, wonderful, no doubt about it.
So I'll just like to add one thing. In March 2020, when the COVID struck, these BSE Sensex came down from 41,000 to 26,000. And everyone went dizzy, it's going to go down to 15,000, 10,000. And there was a headline in one of the finance magazines when the stock exchange started rising from 26,000 to 38,000. What next? But if you see in the hindsight, today it is at 79,000. So anyone who remained invested or invested at that time would have tripled his wealth. So I request now Dr. Rajiv Khandelwal sir to please make a few comments, and any questions, please take up the questions.
Thank you, Dr. Manish, for giving a very good talk on equity, for letting the youngsters know how to go about investing. Now, I have a few questions. What should a person of, say, age around 60 years do? Should he invest more in equities, or would you suggest some other investment?
Sir, firstly, it depends at age of 60, how much fund he is having. Because at that time, he may be a person who is earning well, like his daily expenses, monthly expenses, annual expenses are well taken care of, and he has surplus money. If he has lot of surplus money, more than 50% of his surplus, definitely he should keep on investing, because then he is investing for his future generation. Or if he is a person who is retired person, he has got retirement funds, he would like to pay safe, provided we consider he doesn't have arrangement for his monthly expenses. At that time, he would like to have funds, at least funds 20 to 40% funds in such a fund where it gives you monthly returns. Like they say, if you keep on withdrawing 4% from a portfolio of more than 10 crore, that portfolio by itself keeps on appreciating and remaining maintained for your returns.
No, do you agree with the formula 100 minus age with the amount which should be invested in equity and
Yeah,
debt?
that is there, but that is for younger age, and that is like a big guideline. But you cannot specifically say to suppose a retired person is there and he gets a 20 lakh rupees and he has expenses of 50,000 or 1 lakh. So we have to go differently with different person. Actually, the formula is true. What is 100 minus age? So if your age is 60, then you can keep 40% in equity, provided you have surplus big funds.
Yeah, another thing, the market has corrected a lot. Do you think one should invest all out at this moment, or should stagger the investment?
Sir, it should be always a staggered investment, specifically when we see the next 6 to 12 months, you are expecting a correction, but then you don't say correction, you say consolidation.
Okay.
Because initial person, whenever he starts investing, na, he's a very, having a very delicate heart and mind. And it is, new investor doesn't like the red color in your portfolio. He likes the green color. He enjoys the green color. If he has 15 green color, 2 red colors, he will be very depressed. He will be very disappointed. So having a SIP tool is, it all staggers down, it all averages your return. And if you are having horizon of more than 3 years, it is always better to do a systemic investment plan, fixed amount, keep on investing for next 12 to 36 months, and 5 to 7 years, you will have beautiful returns.
Thank you. Dr. Ajay, you can open the house. You are on mute, Dr. Ajay.
Dr. Ajay Kumar, sir, please, your expert comments.
Uh, Thank you, sir. Wonderful presentation by Dr. Manish. I have seen him talking earlier also, but the depth of knowledge of the companies and categorization and classification and its today's um, potential growth, that is what we have to look at it. And I think he has studied well the background knowledge of the theoretically of the companies, like what is the sunrise industry. My only question is those who are newcomers, I think selecting an individual stock requires a knowledge of your level. But a new person who wants to invest in the stocks, he has to read a lot, he has to wait for a long time, and he has to have a lot of patience. And then only he can pick up a winning stocks. Otherwise, these stocks, we all have burnt our fingers actually earlier, right? We have invested in some companies which have vanished. They are not there in the stock market at all. They are not even trading or not even listed. So that sort of a situation not to go for initial people. I will feel that you have to wait for 2 years to learn this knowledge, at least 2 years. That's
I
my.
fully agree with Ajay, sir. In fact, initially, I feel at least 80% should be in mutual fund and index fund. You can use just 10% and 20% for equity if you have passion and a deep desire to learn about direct equity. And if you don't have time to do that, it is better to keep 100% in your mutual fund or index fund. Very true, sir.
So there
Thank you,
is
sir.
some guidelines, sir, Chairman, sir. If you have 1 lakh investable fund every month, you can dabble in individual stocks. If you have less than 1 lakh investable fund, it's just a rule of thumb. Vipul Jain sir's next stock will be the most appropriate to invest because you don't lose money there. Definitely. I mean, for a large safety margin will be there.
So
Index
the
fund.
next talk is how to start investing in the equities,
Right.
the vehicle to invest in the equities. But my only request is once we are thinking of investing in equities, we should have a at least sizable sum. Just investing 5 to 10 lakh rupees when you have a house worth 10 crores or your FD is worth more than crores, and investing 5 to 10 lakhs in equities does not make sense. You must have at least 20 to 30% of your financial assets in the equities. So for the next talk, I request Mr. Shiv Subudhi to please introduce the speaker.
Yeah, thank you.
Mr. Shiv Subudhi is MTech, and he had been working with TCS for more than 35 years. Now he has become a financial analyst and is a good friend. I request him to please introduce Dr. Vipul.
Yeah, thank you, Dr. Ajay. So the next talk is on our especially for the beginners who want to enter into equities. It's index mutual funds, easy way to generate wealth. It's been taken by Dr. Vipul Jain. So Dr. Vipul Jain is a senior pediatrician in Delhi, and he's also an expert in technical and financial areas. So I would like to invite Dr. Vipul Jain to take the next talk.
Thank you. Thank you, sir. I would defer. This is also for experts. And Ajay also introduced initially. See, mutual funds or index funds investment, if market is not your core expertise, then putting money into them, even if you are a CEO of Zomato, then you would also put money into mutual funds and index funds when you are having salary of millions. So it is not for beginners. It is for people, those who want to create wealth. There is a evolution of investing. If you see 100 years back or maybe 70 years back, stocks was the only option. Then somewhere in 50s, 60s, the concept of PMS started and private companies came into forming PMS. And somewhere in 60s, 70s, mutual funds in US started. In India also, we had a few mutual funds in 70s. UTI used to have mutual funds in India at that point of time. But beyond mid 70s, categorically in 1973, the concept of index fund came into US and it has spread all over the world now. So smarter money is going into index funds. It is not individual stock investing. Now, wealth generation is defined how you deal with money. It is not defined that how much you earn. It has no relation कि आप कितना कमाते हो, कम कमाते हो या ज्यादा कमाते हो. आपके पास ज्यादा वेल्थ इस पे डिपेंड करेगी what you do with that money that you earn. In long run, tortoise wins. If you are disciplined, if you know what is to be done with the money that you have earned. There is another look at the basket of flowers. Manish can say, I like pink. Ajay can say, I like red. Shiv can say, I like the brick red color ones. But मेरी लाइकिंग, अजय की लाइकिंग या शिव की लाइकिंग से इट डजेंट मैटर कि कौन सा फ्लावर अच्छा है. सारे फ्लावर अच्छे हैं. तो बंच ऑफ फ्लावर अगर आपके पास है तो वो सारे अच्छे लगेंगे और वो सारे अच्छे दिखेंगे और सारे अच्छे ग्रो भी करेंगे. तो सेम principle applies to your money. If you want to really grow your money, you want to generate wealth out of your money, so invest into a product which has all the flowers, all the colors, छोटे बड़े रंगीन सब हों उसके अंदर. आपको पता नहीं कौन से सीजन में कौन सा खिल जाएगा. पकड़ते रह जाओगे. 90% जो एनालिस्ट होते हैं वो रेट्रोग्रेड एनालिसिस करते हैं. जो खिल जाता है कहते हैं ये खिल गया. वो ये नहीं बता पाते कि ये वाला खिलने वाला है. And invest in India. When you invest in bunch, you invest in India. In 1991, reforms started. And since then, we have seen the growth of Indian industry. India की population पहले negative मानी जाती थी. Now population has become positive thing for India. Why Zomato, Swiggy and things like that are growing? They have a very cheap labor. आपको 15 रुपए में डिलीवरी बंदा दे जाता है. That is why you are availing Zomato's Blinkit service. लेकिन अगर यही बंदा 150 रुपए ले रहा होता ना डिलीवरी के तो you would have rejected Zomato Blinkit long back. इंडिया की ज्योग्राफी बहुत अच्छी है. Connected to the most of the world. It is centrally placed, diverse है. And that is why it is growing. So invest in complete India. Do not try to choose कि मैं ये इंडस्ट्री अभी ये चल रही है, अभी एनर्जीज में बहुत पैसा है. यू नेवर नो कल को कौन सी सडनली इंडस्ट्री आ जाए या जो एग्जिस्टिंग इंडस्ट्री है उसकी साइकिल चालू हो जाए. तो इन्वेस्ट इन द कंप्लीट बास्केट. India has a demographic advantage. India mean age currently is 29. That means our reproductive age group is at the maximum number, plus the same age group can be more productive also. So this advantage is going to be there in next 20 years. तो कोई अगले 20 साल आपका equities अभी stagnant नहीं होने वाले, गिरने नहीं वाले. They are going to grow for next 2 decades. So invest in India. Think long term, invest in India. Long term is 5 to 10 years. Any investment into equities less than 5 years is not equity investment. Please invest only what you have, what you don't need for next 5 years into equities. There is a high probability that you might lose money if you invest less than 5 years. Ideal is 10 years. Now, this market has so many shares. There are around 2,000 shares which trade very actively, out of which 500 of them are very active. So their classification is based on their market capitalization. Now, if you look at top 500, their market value as on 28th of October, I calculated was 450 lakh crores. Now, this is how you classify them. The top 750 are being classified like this. Let us take them one by one. The giant ones, which comprise almost 45% of your market, they are like elephants. Manish also talked about elephants. These are bigger companies. Is 45% of 450 lakh is around 200 something lakh crore. जिसमें से 10% or 11% is single company called Reliance. 20 lakh crore value है जिसकी. So these are large companies, they move slowly, but they reflect how India is moving currently in general. So if you're looking for your money, which is invested in equity and stable, बहुत गिरेगा भी नहीं, बहुत बढ़ेगा भी नहीं, then large caps. Their growth might be in tune of 12 to 15% fine, but negative will not be again more than 12%. Like some of the sectors have negative growth of 50%, 60% sometimes, but these companies will not have more than 12, 15% on an annual basis. Next, the Nifty next companies or the second part of the large cap companies. These are the naughty elephants. They sometimes behave erratically, but again, they are almost 20% of the market, which is out of 450 is 90 lakh crore. इनकी भी एक लिमिट है मूवमेंट की, ठीक है, they might move more than 12-14%, they might move 20% positive negative in a year, but yes, they also have good amount of weightage, so the movement will not be much. Next comes the mid cap. They rank from 101 to 250 as per their market capital rank. These are the kangaroos. They jump a lot. They jump high, they jump down, and these are the one they can make you jittery sometimes. So sometimes you feel like it has jumped very high and you feel very good about it. But there are chances, there might be phases they jump down also. And the fourth one, ranking from 250 to 500, they are called small caps. These are small caps, actually, they are hardly 10% of the market, which means total these 250 companies are 40 lakh crore. So these are very small companies. Some of them are as small as 30-40,000 crores. So these are langurs. A single person can change their value by 10%, 20% in a day, forget about an year. So they are risky. They sometimes multiply, they become double in a year, but they have a capacity to do half in a year also. You also have micro caps, which is hardly 5% of the total. But again, they are squirrels. They disappear sometimes, as Dr. Ajay was mentioning, they have vanished. So they go into their burrows and they disappear. But sometimes they climb the tree also. But very difficult to find which squirrel is going to climb up and which squirrel is going to go into a burrow. Why we are talking about them? Why does all this matter to us? Why this matters to us? Because this forms a bouquet. These are different colors of flowers. You have 4 different types. There is a proportion. There is a market cap proportion of each of them. And if you combine them, you can create a 100% bouquet of yours where 50% is giant, 20% is large, 30% is mid, and 20% is mid and 10% is small. So by doing so, you can create a bouquet. And this bouquet can be very, very useful for you for investing. Now, why this bouquet is important? You have all the stocks, all top 500 stocks with you, and you are invested in a proportion where they stand in the market, and you will reap the benefits as they will grow. This is what mutual fund does. Mutual fund is a dhanda out of the market. Everyone should invest in mutual funds. I am not saying this in a negative sense. This is what mutual funds do. They categorize their funds into that. They have flexi cap, which has all four, and they have multi cap, which has a proportion of 50, 25, 25 of these. So, but it is finally a dhanda. You need to understand how they work. There is a fund manager, he takes money from you, invests in the securities. It is regulated, that's fine. But as compared to equities and others, it is easy to manage your money in mutual funds. You have to choose the right category and invest proportionately into the right categories, and you can reap the benefits out of it. But one of my friend was into ice cream business. One day I went and just I asked him, you must be having a lot of factories because you have 70 flavors of ice cream that you supply. And he laughed at me. He said, no, no, no. I have a very small factory and there is only one supply line. We make only one kind of ice cream, and it is the base of the ice cream, which has 4 ingredients: milk, water, sugar, and emulsifier in a right proportion. Apart from this, we have color, essence, dry fruits, and fruits, which buy from market. And most of these things are of very cheap quality. And we mix them and we make a permutation combination of these and make flavors of ice creams and sell. Very interestingly, mutual fund industry is doing the same. They are doing nothing else. There is a marketing team behind every mutual fund company, and you have emerging, blue chip, value, contra, opportunities, discovery, advantage, different names to different mutual funds to trap you. Their target is to introduce a mutual fund one day, make it 20,000 crore, and put it aside and make another mutual fund next year. So this is how they work. Now they say that all mutual funds say that हमें आते हैं shares देखने, हम जानते हैं कौन सी company best करेगी, and we know how to make a portfolio which will beat the market. So Burton Malcolm from 1950s he did a long-term study and published all of them in mid-70s, early 70s, where he trained few monkeys to throw the dart. And he used to place 50 names on the wall, and monkeys used to throw 10 darts. And these 10 darts, which used to fall on the name of the company, a portfolio was made with them. And he proved that all my monkeys are better than fund managers. They can beat fund managers easily. Statistically, he proved that. So this is what mutual fund guys say, that we outperform. Now, this is the data before 2018. Because before 2018, mutual fund industry was not that regulated, and they used to put small caps into large cap funds, vice versa. And they used to fool people by choosing equities which were not in that category. But still, before 2018, 68% of these funds underperformed. And if you look at different proportions, almost 70% of the mutual funds underperformed the basic index. At that time, we are just comparing it one index. So not all. So they are at that time, it is being compared with Nifty 50, not others. But in coming presentation, I will compare it with others also. Now look at this fund. How the performance changes with time.
हाँ
4
चलो दूजे
star,
तीजे
4
दिन आ
star,
गया
3 star, 1 star, 1
हाँ
star,
कोई गल नहीं कोई गल नहीं
star.
ਜਦੋਂ ਆਏ ਦੋ ਲੈ ਆਏ
Dr. Bajaj sir, please keep yourself mute. Dr. Bajaj sir, please keep yourself mute.
So these funds over a period, they change, they do not perform similarly. मोस्ट कॉमन सिनेरियो 15-16 में आपने इसको 4 स्टार देखा, इन्वेस्ट कर दिया, 17-18-19 में ये 1 स्टार हो गया. दिस इज द मोस्ट कॉमन सिनेरियो बिकॉज यहां तक उस कंपनी ने ध्यान दिया इस पे, उसके बाद ये गायब हो गया. दिस इज स्पीवा इंडिया स्कोर कार्ड. Large caps almost 80% underperform. ELS is almost 70% underperform. Mid and small cap
ये
almost
गुरजीत ਨੂੰ ਲਾਈ
60%.
ਆਵਾਜ਼ ਨਹੀਂ ਆ ਰਹੀ ਅੰਦਰ ਆ देखिए आवाज तो नहीं आ रही
सर म्यूट कर दो ना जो भी है सर ये. So these are
Dr. Vipul, अपने आप को अनम्यूट कर. ठीक. ठीक. Please carry on, Dr. Vipul.
so, this was done, Dr. Ajay. Dr. Ajay,
Yeah. It's the
Okay.
previous slide. हाँ, this one. Yes.
This one. Okay.
Last one. ये हो गया था.
Okay.
Next one. Yes.
So large caps almost 80% underperform. ELSS almost 70% underperform the index. Mid and small cap almost 50 to 60% underperform the respective index. So these mutual funds, despite of being charging so high for saying that we overperform, they underperform. Now let us come back to ice cream. Ice cream, as we said, has 4 constituents: milk, water, sugar, and emulsifier in right proportion. So let us see what our NSE 500 has. It has all milk, water, sugar, and emulsifier in right proportion. And this is where we need to invest. We don't need to invest सिर्फ लार्ज कैप नहीं करना, सिर्फ स्मॉल कैप नहीं करना, सिर्फ मिड कैप नहीं करना, या सिर्फ निफ्टी नेक्स्ट नहीं करना. We have to combine all together in the right proportion and we have to invest accordingly. Now, this is what index funds do. These are the ice creams without colors and essence. Although recently color essence लोगों ने इंडेक्स फंड में भी डालना शुरू कर दिया है क्योंकि बहुत पॉपुलर हो गए हैं, तो वो भी कैसे बचना है वो भी देखना है. Index fund was initiated initially in 1973 by John Bogle. He's called Jack, father of index funds, and he suggested कि प्लीज ये म्यूचुअल फंड्स के चक्कर में मत पड़ो, रैंकिंग के चक्कर में मत पड़ो, ये स्टार्स सब गड़बड़ हैं, एंड just invest in the bunch of index funds. These indices are defined by SEBI and their proportion, their classification is defined by SEBI. It is not the individual company which defines the index funds. एंड आज की डेट में वैनगार्ड 500 जो वर्ल्ड का लार्जेस्ट इंडेक्स फंड है, उसकी वैल्यू $10 ट्रिलियन है और टोटल यूएस मार्केट कैप इज $55 ट्रिलियन. So almost 10% of the complete US market is single index fund. And it is said that it holds minimum 5% of top 500 companies of US. That means 5% in each company means Vanguard का एक बंदा हर कंपनी के बोर्ड में है. Now this is how index funds work. SEBI fixes the formula, computer manages it. It has negligible or very low expense and auto shifts which fund manager claims कि मैं अपनी अकल से करता हूं. It is all done by computer automatically based on the half yearly results that SEBI publishes on each index fund. your mutual fund charges you 1.5 to 2% expense ratio, which is huge, huge. And it is charged on daily basis on your investment. It is not the entry fees or exit fees. It is the expense on daily basis which is being charged. And if you look at the index funds or ETFs, it is negligible. The auto shifts which they claim are automatic, and reallocation, जो कि नॉर्मली आप बहुत सारे फंड्स खरीदते हो, रियलोकेट करते ही नहीं कभी। आपने स्मॉल कैप खरीदा, 10% खरीद रहे थे या 20% खरीद रहे थे, लेकिन वो ज्यादा हो गया या कम हो गया, यू डोंट रियलोकेट। और अगर इन केस you start reallocating them, there will be a huge long-term or short-term capital gain on that. Every third month, index funds do reallocation based on the formula given by SEBI automatically without any expense. Or I should say without any additional expense. And when I finish index fund talks, a lot of people say they are conservative returns. They don't return anything. 12% देते हैं म्यूचुअल फंड्स और इंडेक्स फंड्स, इससे ज्यादा इंडेक्स फंड्स नहीं देते। अगर आपको 30% लेना है तो इन्वेस्ट इन म्यूचुअल फंड्स। Sorry, this is the wrong impression which has been created. I am not giving you example of Nifty 50 index funds because that everyone knows what kind of returns are there. This is Nifty Next index fund. I am hiding the company's name. Look at 1 year, 2 year, 3 year return. 3 year return is 21%. 1 year return is 63%. This is as on 31st of October. This is mid cap. 3 year return is 33% annually. This is small cap. 1 year is 50 to 60 and 3 year is around 25%. ऊपर नीचे दो में फर्क इसलिए because they are different index funds. Normally all index funds from different companies, if they are serious index funds, their return is almost same, 0.1, 0.2%. They might differ until unless they are not taken seriously by the company. Now again, for index funds also, beware. People are playing game alpha, beta, momentum, quality, volatility. Everything is useless. This is just to increase the expense ratio. Normal expense ratio 0.2, 0.4% for an index fund. But if they want to charge 0.8%, they add these funny things to their names. Because SEBI also introduces index funds with alpha and beta and momentum. But again, plain vanilla flavor ice cream with appropriate emulsifier, sugar is more than enough. Again, get rid of an agent or advisor. Sorry, Shiv, but you have to find whether he's a friend or foe. These 5 funds, which are the most popular funds in Indian scenario, look at the difference in the regular and the direct in last 10 years. 13 lakh has gone to just 10,000 rupees per month SIP for last 10 years in each one of them. That is only 50,000 rupees SIP, which I believe is very less for a pediatrician. It should be more than that. It should be several times more than that. But still in last 10 years, you have given 13 lakh to this person who just suggested you to invest in these 5 mutual funds. In coming years, this 13 lakh will grow into crores because your corpus is going to increase in coming years. So this expense is on corpus on daily basis. So direct is better than regular. Very important message. Thank you. Yeah, I think Dr. Ajay has left. Can we have Shiv for the comments?
Yeah, So thanks, Dr. Vipul. Nice presentation. Some of the thoughts, I think what you're saying is you're right in the sense that many of the fund managers are not able to beat index funds. But then there are some fund managers they are beating also. So it's difficult to say who is better, right? But as a investor, if you just want to do a equity exposure, it's good to have index funds in your portfolio. Whatever equity percentage you want to keep, you can keep it in your portfolio, and that's the best way to start. That's why initially I said it's good for beginners, because if you don't know how to invest in equity, it's better to enter into index funds and at least do the beginning. Later on, it's from your experience you'll know whether your advisor is able to beat the index funds or not. So that you'll come to know from experience.
Dr. Manish?
Dr. Vipul, sometimes if someone asks you, ki, I don't even track between mid cap, small cap, large cap. So what will you advise him? He wants to invest. He asks you, give me a single product. I want to keep on investing in this product for next 20 years. So what would be your answer?
NSE 500.
So
NSE
which
index
companies are
fund
having it?
based on NSE 500. Unfortunately, Indian mutual fund companies were very resistant in bringing this product. Motilal Oswal bought it 3 years back, did not promote at all, and it was not there on their landscape. They did not want anyone to invest into it. It was not showing on value research and things like that. They used to hide it. Even as of now, value research hides all index funds in their search. You have to find them from their tool to where they are, and they have made sure that they don't show up in a normal search. Motilal Oswal Nifty 500 index fund, which started 3 years back, is the right choice. Recently, in October, SBI has started SBI Nifty 500 index fund. Expense ratio of Motilal is 0.2. Expense ratio of SBI is 0.3, which will automatically become 0.2 in a year or so when their corpus will cross 1000 crore. But NSE 500 based index funds is the only one product. It will rebalance itself, it will reallocate itself, and you can blindly invest in these two companies. Both these companies are serious mutual fund managers, and you can sit without any tension for next 20 years with either of these two.
Thank you, Dr. Vipul. Just in brief, can you tell us what is this Dream 11 project and what we have learned in last 7 months from it? In our 250 plus pediatric finance group, we are running it. And fortunately, I happen to be part of it. Dr. Vipul takes lot of pain to execute it. Dr. Vipul, please.
Yeah, on 29th of February, we started Dream 11 project. This is actually an ongoing research, you may say, which judges what people do when they invest. It has two major arms. One is stock, another is the mutual fund arm. In stock, we told all participants to choose 11 stocks, best stocks for them, and which they can shift two per month for another 1 year, and best return in next 1 year will be decided on 1st of March 2025. And in another, we told them to buy 1 to 5 any number of mutual funds. You can
No, Dr.
choose
Vipul,
one.
just tell us how many people are
Oh, I'm
underperforming
coming. I'm
NSE
coming to
500.
that. I'm coming to that. I'm coming. First, I'm telling the structure. In mutual fund one, you have 1 to 5 mutual funds selected, which are on SIP mode for next 1 year. Uh, Now, in this stock portfolio, the benchmark is NSE 500. Rather, in both of them, benchmark is NSE 500. Out of 18 players, only 4 till date are being able to perform better than NSE 500. Rest all are below NSE 500. There are 4 players, those who are below their starting price in last 7 months. And there are players, those who are having CAGR of 60% also. So there's a huge variance among the players. The bottom line is, even if you would have not done anything, not bought any share, not sold any share, not paid any short-term, long-term capital gain, you could have been number 4. जब आपको पता है आपका बच्चा बिना पढ़े चौथी पोजीशन पे ऑल इंडिया रैंक में आ सकता है, तो क्यों उससे मेहनत करानी है? उसको बोलो बिना पढ़े एग्जाम देकर आ, NSE 500 पे इन्वेस्ट कर.
नहीं, बिना पढ़े नहीं, बिना ट्यूशंस के पैसे तो लगाने पड़ेंगे.
So what is the ratio of small cap, mid cap, and large cap in NSE 500?
This is what it's the same ratio, 50, 20, 50, 20, 20, 10. This is the ratio, official ratio of NSE 500.
Okay.
Dr. Vipul,
This varies every 6 months because SEBI releases the data every 6 months. It varies. Currently, the last release, 45% was the large cap. Yes, sir.
हाँ, एक क्वेश्चन है कि जैसे आपने बताया ना इंडेक्स 500, तो उसमें जो नाम होते हैं, नाम ना इट कुड बी कंफ्यूजिंग. जैसे कि नाम आगे तो मैं नहीं लूंगा, जैसे निफ्टी 500, मोमेंटम, वो आपने बता दिया कि वो सब इट इज ऑल कलरिंग द प्रोडक्ट. जैसे ये मोतीलाल ओसवाल S&P 500 इंडेक्स फंड, S&P यहाँ पे फिर कैसे आया हुआ है? जैसे
सर वो
फॉर एग्जाम्पल
S&P USA है, वो USA के 500 स्टॉक्स में इन्वेस्ट कर रहा है. वो इंडिया के स्टॉक्स नहीं है सर, वो S&P 500 इज द इंडेक्स ऑफ USA टॉप 500 स्टॉक्स.
एंड एक्सिस 500 इंडेक्स फंड,
वो एक्सिस का भी है सर, एक्सिस का भी निफ्टी 500 इंडेक्स फंड है. It exists, but again, it is not on promotion. The company is not serious. The AUM is very less of excess.
okay, and then another is BSE 500 index fund.
Yeah, BSC का भी है सर, BSC का भी है, लेकिन I think Nifty is better positioned because Nifty is something which SEBI looks at, and NSE is basically, NSE or Nifty is the major exchange of country, which has almost 80 to 90% of the transactions. So we should look for NSE based index funds rather than BSC based index funds.
So the plain vanilla flavor and NSE based 500 should be the choice.
Perfect, sir.
Thank you. This I wanted to confirm. Dr. Ajay is back. Dr. Ajay.
And Dr. Ajay
Unmute
from
yourself.
Hyderabad, sir, any comments? Sir, please
Sir,
unmute yourself. Please unmute yourself.
I think Vipul, you can unmute. You are the host.
इसमें भी म्यूट ऑल का ही बटन है.
Unmute. उसके particular
हाँ, हो
उस
गया,
पे
हो गया,
जाओ.
हो गया.
Go
हो गया,
on
sir.
particular that pick. Yes.
Yeah. With the permission of the chair, sir, excellent talk once again. I always get fascinated listening to you again and again on index funds, mutual funds. You come up with new information. Fantastic talk, sir. Congratulations. This is a new information which you have released today, saying that NSE 500 looks like an ideal portfolio stock for us. I don't know what is the background of the past 5 years, 3 years performance of this category of the fund. Can you just highlight?
Sir, fund is new, so about fund I will not speak, but index I can talk about. In last 10 years, NSE 500 has given at all points 2% extra than any other index.
So the index funds are the best funds, but these are like term plans, term insurance plans. No company wants to sell them because they are not profitable to the companies. And these are best for us. So we have to be, and there is a dictum that we should buy the financial products. Most of us are sold the financial products, and agent comes to us, so this is good for you, buy this. But they will never ask what is your requirement. So one must make a choice and buy the product rather than being sold the product.
So there is one question, sir. I know it's not related to the today's whole topic, but ETF and mutual fund, index fund, especially, just few highlight points. Is ETF is good or index fund is good? Say Nifty 50 or Nifty Next 50, ETF or mutual fund?
I think ETF is better than index funds, no doubt about it. And those who were investing in index funds started with ETFs only because ETFs started 15 years back. So we all have invested in ETFs. The only problem with ETFs is you do not have official SIP mode in it and you need a demat account. So these are the two basic limitations. I do not want to have a demat account. I can't operate with ETF. If every time, every month or every week, I cannot log in into my demat account even after having demat account and buy a share. Again, then moving price irritates me. Buy at what price is a difficult job for me. So index funds keeps this off. You don't have to see the price. You just have to put the date, monthly or weekly. SIP goes and at an average price it buys. But in case of ETF, it is the live price you have to buy. If it is high at that point of time, you will get ETF at a very high price. So for everyone who wants a cool life, invest for wealth generation, I think index fund is better in comparison to ETFs. The basic difference in Indian ETFs and US ETFs that needs to be understood to understand why ETF in India is not good. All ETFs in US have FNO back in them, which means the variance in the price of ETF is limited by FNO movement. So that is not there in India. So that is why sometimes it is 2% less or more than the actual price of the actual base price of the index. So ETFs, sometimes you end up buying at a very high price because of the intraday variance. Dr. Jay, can we?
I think we have to unmute Dr. Ajay also again as a host.
करा मैंने अब सबको.
Yeah, thank you. So good evening, and it has been a wonderful session. I think many doubts got cleared, but this was just a beginning because we wanted everyone to be aware of the advantages of having equities in your portfolio. So for detailed discussions, we'll go to Hyderabad. And but for everyone, not only for the beginners, but for the experts also, because what we need is a second income. That we generate a second income without much effort. We focus on our primary profession and let the money work for us rather than we working for the money. So wishing everyone a happy investing, and we'll have more such session in the futures also. And we have Dr. Arun Mandal sir. Arun Mandal sir, are you there? Dr. Vipul, can you unmute Dr. Arun Mandal? He's one of the greatest investors I have met. He has been investing for a very, very long time. We have the last expert comments from him?
It was an excellent talk, and particularly since the area of Vipul covered is new for me. I have been always investing in the, say, direct equity, but I think the investing in a index fund makes sense because I have been putting so much time on this, and ultimately the return doesn't think that it was worth it. But I have already crossed so many years, so I am still doing. But now I recommend my family members to invest in the index funds. Excellent talk. Thank you.
Thank you, sir. Thank you.
So right now I'm at MMC. We have a dance practice here. So see everyone on Sunday, whoever is in Delhi. At the IT annual day. So should we close, Dr. Vipul?
Yeah.
Yeah, as you are the host, please close.
I changed the host. I made you the host actually.
Okay. Should I close?
NSE 500 index fund. Say for 14% return வரும்.
இல்ல எந்த
Thank you everyone for joining in, and we will have